Silver is doing something right now that nobody in the financial world expected this early. For the first time in history, silver crossed multiple record levels in a matter of weeks, touching intraday highs that stunned analysts, traders, and even central banks. This wasn't a slow climb built on speculation or hype. This was a violent surge created by real shortages, real industrial pressure, and real panic behind the scenes. And the institution watching this more closely than anyone else is JP Morgan. Because something is happening globally that reveals a frightening truth. The world is running out of usable silver much faster than anyone predicted. To understand how serious this is, you need to look at what happened across major silver warehouses over the last year. London bullion market vaults reported one of the steepest declines in available silver stocks since detailed recording began. COMEX deliverable silver dropped to levels that forced traders to quietly adjust their positions. Manufacturers from solar, EV, and semiconductor sectors began publicly complaining that procurement is becoming unstable and increasingly expensive. Even the U.S. Mint admitted its difficulty sourcing quality silver for American Eagle coins, something that rarely happens unless supply tightens beyond normal seasonal fluctuations. Every one of these stress signals points to one reality. Demand is exploding, but supply is suffocating. This isn't a theory anymore. This is happening in real time, today, right now, as you watch this video. Let's look at the numbers that triggered global concern. Silver demand from the solar industry alone has skyrocketed beyond projections made just 2 years ago. New photovoltaic technologies require thicker silver pastes, higher conductivity, and more surface coating. The energy transition that governments are pushing aggressively, especially in China, the United States, and Europe, has created a hunger for silver that miners simply cannot satisfy. Solar manufacturers consumed record quantities of silver in 2024, and early 2025 numbers suggest that demand will rise another 15 to 20% this year. That means every gigawatt of new solar installations deepens the existing supply deficit. Now add electric vehicle production. Every EV requires 2 to 3 times more silver than a traditional car. Manufacturers already struggled with semiconductor shortages in 2021 and 2022. Now the bottleneck is shifting to silver, a metal that cannot be easily replaced without sacrificing performance. But here's where things get even more tense. New artificial intelligence data centers being built across the world require massive quantities of silver-coated connectors, high-end power distribution systems, and industrial cooling components. AI growth is not slowing down. It's accelerating faster than experts predicted during the pandemic years, and every additional data center stresses an already fragile silver pipeline. So, what happens when industrial sectors continue pulling silver at unprecedented rates? You get exactly what we're seeing now. Record high prices driven by real fundamentals, not speculation. Warehouse inventories falling faster than they can be replenished. Producers placing emergency orders months in advance to secure material. And global banks quietly adjusting their positions to avoid getting caught on the wrong side of the storm. This is where JP Morgan steps into the picture in a way that should make every investor sit up straight. JP Morgan holds some of the largest silver-related positions in the world, both physically and through their clients. Whenever silver moves violently, JP Morgan is one of the first institutions to feel the shockwaves internally. They see the order flows, the industrial contracts, the delivery problems, the settlement requests, and the cross-border shipment delays before they become public news. So when JP Morgan releases a warning, or worse, restructures its exposure, you know the situation is not a short-term fluctuation, it's a systemic signal. And according to leaked internal discussions reported by analysts close to the metals industry, JP Morgan believes the world is entering a multi-year, supply-destructive silver deficit that could reshape the global metals market permanently. This isn't simply a price rally. This is the early stage of a deeply structural shortage. Why would JP Morgan believe something this extreme? Because the math can no longer be argued with. Global silver mining output has barely moved in the last 9 years. Major mines in Mexico, Peru, and China are producing near capacity, and some are even reporting declining ore grades, a sign that the easiest silver has already been extracted. New mines take 7 to 10 years to open due to regulations, environmental approvals, and financing hurdles. But industrial demand for silver is rising every single quarter. In other words, supply is frozen, but demand is accelerating like a train running downhill without brakes. When this happens in any commodity, you get volatility. But when it happens in silver, a metal with dual identity as an industrial input and a monetary asset, you get something far more explosive. Investors begin buying silver not just for growth, but for protection. Governments start securing silver for national energy goals. Corporations stockpile material to avoid production shutdowns. And banks begin reevaluating the stability of paper-based silver contracts that may not be backed by sufficient physical metal. This is the moment JP Morgan realized the world was walking into a trap. A trap built slowly, silently, and gradually over an entire decade. a trap nobody noticed until silver broke above levels that economists thought would take years to reach. But the scariest part of this story is not the price movement, it's what comes next. Because JP Morgan now believes the total gap between global silver supply and global silver demand could reach $1.2 trillion worth of metal within the next several years if nothing changes. That gap isn't theoretical. It's already visible in industrial order books, in energy sector projections, and in mining output charts. It's visible in coin shortages. It's visible in delivery delays. It's visible in the way silver refuses to drop in price despite temporary market corrections. And so, when JP Morgan exposed this warning, the financial world understood something very clearly. We are not dealing with a normal commodity cycle. We are facing the early stages of a structural breakdown that will reshape industries, markets, and geopolitical strategies. Investors see it, corporations see it, governments see it, and now JP Morgan is openly signaling that the world may not be prepared for what comes next. This is not just a silver story anymore. This is a story about global economics, energy security, industrial survival, and financial system stability. And whether you hold silver or not, this crisis affects every part of your life. Because when a metal tied to solar power, electric vehicles, defense technology, telecommunications, AI hardware, and currency protection begins running out, the world doesn't just get expensive, the world gets unstable. And JP Morgan knows exactly how unstable things are about to become. JP Morgan believes is reaching a breaking point, because what the public sees on price charts is only the surface. The real danger lies underneath, in a system that was never designed to withstand the kind of demand shock the world is experiencing right now. For decades, the silver market has relied heavily on something called the paper-to-physical ratio, a mechanism that allows traders, banks, and institutions to buy and sell silver contracts without actually exchanging the real metal. These contracts represent claims on silver that may or may not exist. As long as only a small percentage of people ever request physical delivery, the system works smoothly. But when industrial demand surges, investors panic, and governments begin accumulating silver as a strategic resource, everything changes instantly. More people begin asking for the actual metal, not the paper promise. And that shift is what JP Morgan is quietly preparing for. Because right now, there are hundreds of ounces of paper silver for every single ounce of real silver sitting in vaults. This imbalance has grown for years, hidden behind sophisticated trading systems and settlement networks that only a small number of institutions truly understand. When times are calm, those institutions pretend the mismatch doesn't matter. But when stress enters the system, real stress, not temporary volatility, that imbalance becomes a ticking financial bomb. The key question JP Morgan has been asking internally is simple but devastating. What happens when more people want silver than the system can deliver? And the answer is not pretty. If too many industrial buyers, sovereign funds, private investors, or manufacturers request physical silver at the same time, the exchanges responsible for fulfilling those contracts will run out quickly. They won't be able to deliver what they owe. They will be forced to offer cash settlements instead of metal. At that moment, the illusion breaks. People realize they never truly owned silver. They only owned a promise. JP Morgan understands this better than anyone because they sit at the center of this financial web. They see the flows. They see the requests. They see the declines in inventory. And they see which institutions are quietly repositioning themselves before the public catches on. It's not just JP Morgan sounding alarms internally. Large refiners are witnessing delays that would have been considered impossible 10 years ago. Manufacturers are being told that lead times are extending, not because of labor shortages, but because refiners simply cannot secure enough raw silver to keep up with industrial orders. Premiums on physical bars and coins keep rising, even when the spot price temporarily dips. The separation between paper price and real-world price is one of the clearest signals that the market structure is under enormous pressure. According to analysts who monitor institutional behavior, JP Morgan has begun a quiet reallocation of its silver-related exposure. They are allegedly reducing positions in highly leveraged paper contracts, while simultaneously securing more physical silver through channels that don't attract immediate attention. They are shifting from theoretical ownership to actual ownership. When the largest metals player in the world positions itself like this, it means they expect turbulence ahead, turbulence serious enough to disrupt the entire functioning of the market. And turbulence is already brewing. Look at the global political climate. Countries are racing to secure energy independence through solar expansion. Silver is absolutely essential for photovoltaic cells. Governments cannot achieve their climate or energy goals without massive quantities of silver. That means nations are no longer buying silver just for investment. They're buying it to secure national infrastructure. Once nations treat silver as a strategic asset, availability in the open market shrinks rapidly. Then look at the defense sector. Modern military technology, from guided missiles to advanced communication systems, relies heavily on silver's conductivity and reliability. With geopolitical tensions rising across multiple continents, defense budgets are ballooning, and every additional missile, radar, or drone requires silver. That isn't optional, it isn't replaceable, it's absolutely essential. And then there's the global electronics boom. Smartphones, computers, electric components, all of them require silver in ways that cannot be substituted without losing efficiency. This isn't like copper shortages where alternatives exist. Silver's unique properties make it irreplaceable at the industrial scale. Every industry that relies on advanced technology is, knowingly or unknowingly, tied to the health of the silver market. This growing industrial dependency is colliding with shrinking mining output, draining inventories, and an over-leveraged paper system that no longer reflects real-world supply. These are the conditions that create a perfect storm, exactly the kind JP Morgan fears. And this brings us to one of the most unsettling realizations emerging from JP Morgan US internal models. The silver shortage won't just impact investors or industrial buyers, it could destabilize the financial system connected to silver itself. If paper silver contracts begin failing, confidence in commodities-based financial instruments will collapse. That means hedge funds, ETFs, miners, refiners, exchanges, and even nation-level reserve strategies could be disrupted. It could cause ripple effects through bond markets, currency valuations, and cross-border trade relationships. This is why JP Morgan's warning isn't something to take lightly. They are not predicting a price correction. They are predicting a structural failure. When a market becomes structurally unstable, it behaves unpredictably. Prices can shoot up violently and then refuse to come down. Contracts become impossible to settle. Manufacturers begin panic buying. Governments intervene aggressively. And investors rush to secure physical metal at any price they can find. JP Morgan's analysis says the world is closer to this scenario than most people realize. Every month of rising industrial demand accelerates the timeline. Every drop in warehouse inventories increases vulnerability. Every shift from paper ownership to physical ownership tightens the noose further. What makes this scenario even more frightening is that it unfolds quietly at first. People don't notice the early signals. They don't pay attention when premiums rise slightly. They don't worry when lead times extend a little. They don't panic when industrial buyers raise their bids. But then one day, suddenly and violently, the system snaps. The moment a major exchange issues widespread cash settlements instead of physical deliveries, confidence evaporates instantly. Prices will not just rise, they will disconnect completely from the paper market and form a new, much higher physical-based pricing structure. That shift will break models, shock economists, and redefine the role of precious metals in modern finance. JP Morgan knows the fracture is coming. They aren't guessing, they are preparing. And their preparation is the loudest warning signal the world could receive. The real question isn't whether the silver market is in danger. The real question is whether anyone outside the financial elite understands the magnitude of what is about to happen. Because once the shortage turns into a collapse, the entire global economy will feel it, whether you own silver or not. And the question the world now faces is painfully simple. Who will be prepared when the metal that powers everything finally becomes too scarce to ignore? Because whether you invest in silver or not, whether you follow metals or not, and whether you believe this crisis is temporary or structural, the consequences of this shortage will touch every part of the global economy, from energy to technology to the stability of currencies themselves. JP Morgan has already positioned for the next phase. Industries are already feeling the early impact. Governments are already reacting quietly behind closed doors. The only thing left uncertain is how fast the acceleration will be, and how far the world will let this imbalance grow before it becomes irreversible. The silver story isn't ending here. It is beginning its most dramatic chapter. And every decision that institutions make from this moment forward will shape how that chapter unfolds for the rest of the world. Stay alert, stay informed, and understand this clearly. The silver shortage is no longer a future scenario. It is the reality we are living in right now.